Today, after the rate hike deluge. Hello again, it's Martin North from Digital Finance Analytics. Welcome to his post covering finance and problem news with a distinctively Australian flavour. Today, I'm joined by Peter Marshall from Mozo. Hi, Peter.
Hi, Martin. Great to see you again.
Yeah, thanks very much for coming back on. And I wanted to pick your brains post the RBA's 50 basis point move yesterday. It wasn't really that surprising. It had been well signalled. But I'm interested in the consequences, firstly for households, but also for the different rate moves that have happened and may happen. So let's start there with your sort of top line reaction. Any surprise with regard to 50 basis points?
Oh, no, I think the RBA signalled that one quite well. They've made it clear that they're aiming for a cash rate of about 2.6%. And, yesterday's increase takes the rate up to 2.35. So we're almost there, but there's still a little way to go. It is the fifth month in a row that the RBA has increased the cash rate. So it's quite a steep set of increases we've been going through. And I was having a look, the last time that the cash rate increased at all was back in 2010. And you have to go back to 1994 to see increases anything like the current progress. And so, a lot of mortgage holders just haven't been through this situation at all before. So it's quite new.
Yeah, you make a very important point, I think, about the fact that this is a new environment. And I'm still seeing in my surveys a lot of households really haven't come to terms with the new environment that they're now sort of heading into. And there is a bit of delay, isn't there, between when the RBA makes a rate announcement and actually the debit increasing on their accounts.
Yeah, that's right. So lenders are required under the responsible lending regulations to give people at least a month's notice of their repayments increasing. So, there's usually about a month before lenders actually apply the new rates to their customers in their systems. With those two pieces having to happen first, it's at least a couple of months. And in some cases, like CBA, where they recast loans and recalculate repayments across the loan, that process can mean it takes several months. And with CBA holding about a quarter of Australia's mortgage book, that's a fair chunk of people. I don't think that we've seen the full impact of these rate increases yet. But over the next month or so, a lot more people will be starting to feel the change.
And you make a very important point there about the different banks have different sets of processes around the way that they handle those mortgage rate rises once they've made the decision about what to do. Of course, so far, we'll wait and see whether they'll go 50 basis points. They probably will, though, won't they?
Oh, I expect the vast majority will. That's certainly been what we've seen over the recent increases. Most lenders are increasing their rates by at least 50 basis points. Some smaller lenders are going a little bit more. But having said that, there are particular loan options that lenders are holding back on increasing by the full amount. So, I'm talking about mostly basic loans without offset accounts. They tend to be the cheapest rates that lenders offer, and mostly for owner-occupiers with low loan-to-value ratios. So those are great headline rates for lenders to have out there. And once they've got customers talking to them, they can engage with those people and talk about whether it's the right option for them or not, and perhaps put them on a higher rate than they may have come through via an advertisement. Some interesting tactics going on with pricing.
Yes, it's a bit of a hook, isn't it? Get them through the door and then convince them there's an alternative which may cost them a bit more, but it might be better for them. Funny that. And it's interesting also that CBA had actually taken a couple of their variable rates down a little bit over the last couple of weeks.
Yeah, and that's a good example of what I was talking about. Lenders are sometimes, increasing rates by the full amount, and then a few weeks later, we'll see them trim sort of 10 basis points or 20 basis points off those rates. So last month we saw a couple of lenders do that. I think it was ING and Bank of Queensland both did that. But others are just not increasing by the full amount from the start.
And the other side of the equation, of course, is deposit rates, because you should see a rise in deposit rates in theory as well. But there's still a bit of a gap, isn't there, between the mortgage side of the book and the deposit side of the book?
Yeah, deposit rates were slow to start moving. Over the first couple of increases, there was hardly any movement at all. But having said that, there are plenty of increases coming through right now, and some really interesting shifts in the market as well. ANZ last month introduced a new app, and it's tied to an everyday bank account that gives you banking without most fees, and also a savings account. That savings account offers 2.7% with no conditions attached, and that's pretty much the highest unconditional savings rate you can get right now for at-call funds. There's only one account that's a little higher, and that's Alex Bank, and it's offering 2.75, but that account is only open by invitation at the moment. And all of the other rates are very conditional. So there's Ubank actually announced yesterday that they were increasing their savings account rate. It's a conditional bonus rate to 3.35% starting from the 1st of October. So that'll be one of the highest around.
And of course, some of the term deposit rates are also now much more respectable than where they were just 6 months ago, which sort of changes the dynamics for some people in terms of thinking about savings if they've got savings. So, we should underscore that there are some beneficiaries here of higher rates on the savings side. But you have to shop around, and you have to be very careful about what you get yourself into.
Yeah, term deposit rates were increasing rapidly over the first half of the year, but it's definitely slowed down at the moment. The best 1-year rate right now is 3.65%. That's not a whole lot more than Virgin Money's 3.3% conditional at-call rate. So the differential that had existed between at-call funds and fixed term funds has narrowed quite considerably. And the best you can get for even a 5-year term right now is 4.4%. So sure, that's a little bit more, but it's a really big commitment to put a stake in the ground and say you believe that at-call rates won't be at that level or higher within the next 5 years.
Place your bets. That's always it, isn't it? When you're taking a punt on where the markets are going, nobody knows. And there are people suggesting the markets will see rates go slightly higher but then come back down later. And of course, the question is, well, when and how far down? One other question, the refinancing story is quite interesting at the moment, right? Because there are still quite a few people able to refinance and can go on to lower loans, but we are starting to see now some barriers for some types of households who perhaps aren't within the normal bell curve, as it were, in terms of income and payments and things. So what's your read on refinancing?
Yeah, it is becoming more difficult for some people to refinance. If you have a high loan to value ratio, you'll find that you're locked out of a lot of the best rates. But also the credit assessment process may be harder. Costs are increasing. The assessment, the assumed rate that banks have to assess you at before approving a loan, so taking into account potential future increases, has gone up. So it is tighter than it was a couple of years ago. But having said that, a lot of the best rates that are around right now are for people who are refinancing, and there are some really good cashback offers. You do have to be careful with those. I'm always a bit wary of them because you could be paying a higher rate, which negates any benefit of the $3,000-$5,000 cashback that you might be getting. But for some people in some situations, those offers can be really appealing and make a lot of sense.
Yeah, so again, it's important to shop around. And I still find, even in my surveys, even now, there are many people who are sitting on rates significantly above the ones they could get if they just bothered to look.
Yeah, and it's incredibly important right now to know what rate you're on. I've observed several situations where people have seen rate cuts being announced, then checked what rate they've been on, and found that they're paying, almost a whole percent above that rate because they've been with that lender for a number of years, and the lender has not been matching its headline new customer rates to its backbook rates. And one particular situation that happened recently, person saw that they were overpaying by quite a bit. They approached their lender, had a discussion with them, and they got a rate that was actually lower than the headline rate that that lender is advertising right now. So it was a significant rate reduction and will save them thousands and thousands of dollars just from doing a little research and taking the time to contact the lender to discuss the situation.
Yeah, you make a really good point there. Get informed first and then call your existing lender and say, hey, this is what I can get. What are you going to meet me with? And they will be pretty desperate to keep your business, won't they?
Yeah, it takes so much time and effort to get a new loan on the books compared with keeping an existing customer and adjusting a rate. They definitely have room to move, and people should be approaching their lender and applying some pressure. But yeah, it helps to be armed with some facts about what similar loans are out there, what price those loans can be got for. But lenders are very prepared to look past the headline rates and do deals.
And with regard to that process, generally for mortgage holders, are they best to go direct to their current lender first, or is it best to go talk to a mortgage broker? Which is the best route, you think?
Oh, I think going to your current lender direct first is the best way. It's a fairly simple conversation. All you need is a little bit of information about your loan and what is on offer on the market for similar types of loans. And there are plenty of comparison sites such as Mozo, where you can do some quick searches, see what's around, and arm yourself with some good information.
That's the beauty, isn't it, with the technology that now exists and the ability to access a wide range of information online. You can get informed quickly, and it's the quickest way that I can think of to save a lot of money if you actually make the right phone calls. So it's worth doing the work. And just before we finish, credit card rates, real no change, still horribly high, right?
Yeah, we've seen a few lenders increasing rates, but they tend to be mutual banks that where their credit cards very much move in line with the cash rate and traditionally have. There have been a few other lenders, such as Latitude, who have increased rates on their cards, but they were always high rate cards anyway. So I don't think that the people on those products are terribly rate sensitive.
Well, either because they've got no choice or because they just don't know what the rates are, or, as you say, they don't care. But generally, my perspective has been for some time that putting long-term debt on credit cards is just doesn't make a lot of sense. There are better alternatives out there. And indeed, the old strategy of paying off high interest rate debt first makes quite a lot of sense, I think.
Yeah, if there's anyone who's got a high credit card debt, there are lots of personal loans out there that will give you a lower rate and help you consolidate your debts so that, if you have several credit cards with outstanding balances, you can group them all together, get a lower rate, make it easier to manage and pay less interest.
Yeah, sounds like a win-win. And just as we close then, the RBA sort of signalled more rate hikes probably, not quite sure how far and how fast, but we've got to expect that rates are going to stay high for some time, don't we?
Oh, I'd say at least for the next 6 months. But beyond that, global factors may overtake the current central bank position and start forcing a bit of a rethink of where things have been going. But for now, we're looking at another increase or perhaps even two.
Right. So that underscores the need to understand where your rates are, seek out the best rates, use the tools that are out there, and frankly, manage your finances proactively in this upcycle.
Yeah, look, it's not the most interesting thing to work on, but even half an hour's effort can really pay off.
Peter, I appreciate your time today. Thank you very much. We'll chat again down the track.
Thanks, Martin.
Thanks. Take care.